Good morning, I'm Chris Beach and welcome to Charting the Markets on IG Live. And it's US CPI day, the main event of the week in data release terms, which means we are focused on what those numbers could mean for markets. After a mixed week at best so far for equity markets, particularly, you've seen losses across the board really in the early part of the week. Some signs of a recovery from Wednesday onwards, but overall a slightly negative tone still prevails. That caution ahead of what that CPI figure might mean for markets certainly playing out there. And that's the driver at the moment. We had, of course, China falling into deflation territory yesterday with its CPI readings that came after that very poor trade data early in the week, which, as we saw, really put a negative tone on trading across a lot of markets. That has been eased slightly, but overall there are still concerns that the global economy is still facing a tougher outlook. Moving over to other markets, we're looking at a better open today for European markets, and indeed US futures looking stronger. So perhaps there's a hope that we'll see a further slowdown in US CPI growth, which again reduces the stress on the Fed to push further forward with interest rate hikes. Otherwise, it's a little bit of an interesting morning in FX markets. Not much data to drive these, really. Again, it's the focus is CPI, but you are seeing a slight softening of the US dollar as well, and some notable strength coming through in euro dollar, which appears to be forming a higher low once again. And then in commodities, gold moving higher in early trading after what has been a tough week for that commodity. Oil prices, though, having a strong week, rallying to their highest level since the start of the year. Beginning with the indices, starting with the FTSE 100, currently trading at 75.84, and you can see that the index continues to try and recover from the lows around 74.50 that posted a week ago. Really, in the wake of that Bank of England's decision, the index finds itself around about 70 points higher from there, and back above the 50-day moving average. So that means that we could see perhaps a move to the 200-day moving average around 76.40. And then the next big level to watch becomes 7,700, which was the level last seen right at the end of July, when it seemed like a breakout could be in progress. But for the moment, that has been stalled. And of course, it echoes what we saw in June when the index tried to rally and break out from trendline resistance and then faltered. So that would be the near-term target in the short term, with 7,500 continue to act as support. If that is broken to the downside once again, clearly the risk of a move back to these July and indeed March lows around 72.30 increase very rapidly, and suggest that maybe the index is in for a much tougher time during the course of August. Looking to the DAX, an attempted rally this morning has run out of steam, which has sort of spoiled the picture of a possible rebound we had yesterday. Tuesday's price action saw the index rally back from 15,700. So that's holding a support once again for the time being, something well worth watching. I think if that breaks the downside, you do maybe start to worry that we could see a swift move back to 15,500 or even the 200-day moving average. But for an index that hasn't really gone anywhere since May, it's holding up relatively well. It's just that we're not seeing sustained upside. You can rightly point to the fact that just at the end of July, we did record a new record intraday high for the index. So the buyers are still there. It's just that we are now entering a period of consolidation. Weaker Chinese data has been affecting European markets, really, and that's what's led the DAX to stumble over the past week or so. And undoubtedly caution coming through in early trading today ahead of that US CPI figure. So stuck below the 50-day moving average for now, back below 16,000. It's not been a great time for the DAX, but of course markets go up, they go down, they also go sideways, and that's a point I think forgotten by a lot of people sometimes, and that's exactly what you've got here with this index, which is perhaps not surprising given the size of the move from the September lows down at 12,000 back up to 16,000. 25% gain for the index, consolidation of 2 or 3, 4 months, even longer, is not particularly surprising, I think. Overall, I think it would be hard to be too bearish on this index unless and until it goes back, firstly below the 200-day and then below these March lows, which, if you look back to the FTSE, of course, we're much closer to those March lows than we were for the DAX, whereas if you look at the DAX, we're still well above where we were in March. So uptrend still very much the case. A new higher high recorded about 2 weeks ago. So it doesn't pay, I think, to be too bearish in the short term, and certainly the price action doesn't really support that view at present. So I would not be surprised over the course of time to see this renew itself and push on back towards 16,500 and then potentially higher too. US markets, a mixed day at best yesterday. Well, they did show signs of recovering. Once again, for the second day in a row, the 35,060 level provided support. So that's interesting that buyers are still willing to step in and defend those levels. It's just that we've lost all about 300 points from the highs we saw just at the beginning of August. This index really isn't even in pullback mode. It's more just consolidation after its rally from the early weeks of July, around about 900,000 points lower from where we were. Higher, sorry. So it was around about 1,000 points lower then and where we are now. So it doesn't look as if we are due any kind of major declines. Of course, if you get a CPI reading that's stronger than expected, it might then arguably put more pressure on the Fed to do another couple of rate hikes. Arguably, it needs to be a very big beat on CPI, I think, to do that. But that might just cause a bit more of a wobble for indices. And it does look like what with the US credit downgrade last week, that poor Chinese trade data this week, you had downgrade of US banks as well during the week. There are reasons perhaps to be cautious in the shorter term, and it is August, and the usual caveats apply about trading in August. It might be that we just get some more short-term declines that nonetheless leave the index well placed for its traditional year-end rally, because it is coming up. We're in Q3 now. Q4 isn't that far away, and it's a pre-election year, which for US markets is usually their strongest performer, and indeed that continues right into the end of the year. So history suggests that you could still see quite a bit of rally into Q4, particularly with recession concerns being pushed further back into 2024. FX markets have seen a recovery for euro-dollar and indeed the pound against the dollar and indeed the dollar against the yen. So that's interesting ahead of that US CPI reading. If we look at euro-dollar, this is back at the 110 level once again. And as I probably said last week, and I certainly have said before, again, when you get these pullbacks in uptrends and indeed retracements in downtrends, it doesn't tend to turn around immediately. It's usually a process, and that's exactly what you've seen here. We had the sharp move lower from mid-July. It then started to find support around 109.30, but has definitely been a choppy period, which is, again illustrates the value of wider stops, perhaps in smaller position sizes, to allow you to ride out this kind of volatility. But you are maybe starting to see this kind of rounded bottoming out action. Close above 110.50 might trigger the view that actually you've seen a recovery. People might go long here with a stop below this low indeed. That was the trade of the week. Trading the trend actually from last week was looking to go long euro-dollar above 110 with a stop below these lows, so that you weren't caught out by too much of the whipsaw price action. But what you get is here sellers firmly in control, downward move, and then the buyers coming back in again trying to defend this. So you can see the up-down nature of this trading, which is again is a reminder that markets, they go up, as we saw in June and the first half of July. They also go down, as we saw the second half of July, and then they sometimes just go sideways as two sides battle it out. That's what you're seeing right now. It looks like, on current evidence, and of course the CPI reading later today could completely remove this view, but on current evidence that the buyers do appear to be gaining the upper hand once again, which, given that we're in an uptrend, would be the kind of thing you expect to see. You're above the 50-day moving average, you're above the 200-day moving average, you've seen higher highs and higher lows. I don't think you can get more uptrendy than that, and that's exactly what you've got here as well. It looks like the buyers are resetting control, so maybe we get a move back towards 112.70 and 113 and indeed higher. Turning to the pound against the dollar, not so conclusive signs of an uptrend reasserting itself, but certainly you've still got that closely fought whipsaw price action that suggests maybe a low might be being formed. And of course, we could be wrong. It could come out, resolve to the downside with a move back below 126 that really starts to dent this uptrend view even more. But I always think it's probably best to assume uptrends or trends themselves continue much more than people think is possible, and we could be yet surprised that if the pound, say, closes back above 128, that could arguably be your price trigger to say, okay, a higher low is now looking to be formed, and we could push back towards 130 and indeed higher from there. So while euro-dollar looks to be further on in its process of forming a higher low, for the pound against the dollar, it probably seems that we've got a bit more to run, and indeed with CPI today, it could yet run for a little bit longer. Could see the pound and the dollar struggle around these levels, and that volatility to continue before one side emerges with a clear move. I think that's what we're seeing at the moment. So above 128 would give the bullish view more strength. Back below 126 would hand the advantage to the sellers. And then with dollar yen as well, rallying to its highest level here since the beginning of July. Here you could argue, just to spoil my thesis, it did arguably bottom and then immediately start to rally. Although, as you can see, it's not been the smoothest move, because you had this swift drop in the end of July back down towards 138, and then it rallied again just to sort of catch people out and frustrate everybody, which is exactly what markets do sometimes. But the dollar once again in the ascendant, buyers moving back in here, because this week, to talk fundamentals, you had some Bank of Japan members saying that the tweak to their policy, which was quite confusing anyway, wasn't to be viewed as too hawkish, and so this has given the yen a bit of weakness and the dollar a bit of strength, call it what you will, and has allowed this uptrend to reassert itself. So it's interesting that we could be seeing the price move back towards 145 over the course of time, and certainly the fact that this week we've seen that reversal after Thursday and Friday last week, 2 days of losses, and then suddenly we were back on the up again. Buyers really coming back in again to defend this. You had a rising MACD, stochastics, another bullish crossover, so it was hard to avoid taking a more bullish view, I think, of this in the medium term. And looking at commodity markets, gold has been on the decline for a couple of weeks now, and while it is slightly higher in early trading this morning, there isn't much of a sign of a firm low being formed, whereas oil, as we'll see in a second, is back at its highest levels for the year. Gold, to go back to this market's going up, down, or sideways idea, it's still, I think, arguably going down. You've seen it continue to track lower the last 3 days. We're back towards this vital area now, what is becoming, I think, a vital area, or should be a vital area, around 1900, which is where we bottomed out in the end of June. And then we've also got the 200-day moving average entering the picture. We're currently in 1901. So this could be where, if the buyers are going to make a stand, they have to make it there. If they don't, then the risk is that gold continues to erode its bullish view. It is really coming under pressure at this point. The fact that we had July's rally fizzled out at 1980 really starts to dent the bullish view quite a bit. So if it goes back below 1900, if it goes back below the 200-day moving average, really the sellers might start to think, okay, we're with a chance here of pushing it down back towards 1800, and that could be how it plays out. So the buyers have to do something, and have to do it fairly soon, I think, really, to reassert themselves, if not to avoid this gold price action slipping into a neutral view, because arguably it still was in the bullish camp as of late June, early July, and certainly the recovery into mid-July gave the view that maybe it was then going to renew its rally and go back towards 2000 and higher. That obviously price action as paramount has negated that for the time being. We're back into a neutral consolidation view. So for the moment, okay, today's maybe, if it starts to recover today and we get again that weaker CPI figure, might weaken the dollar and push gold higher. If it gets back above 1950, that would be a good first step. Back above 1970, 1980, we'd prefer it even more to sort of cement the bullish view, and then on from there. And again, when you're looking at these, of course, we say to buy the dip. People say to buy the dips and sell the rallies in trends. But it's often the case that these things take a while to work out, and you're better trying to catch the longer term move than trying to jump in and assume that, okay, it's stopped going down, now it's going higher. And that's what stops are for, rather than trying to jump in too early. I think that's often, as a famous hedge fund manager once said, trying to call the turn in any market is the most dangerous point. At the moment, we certainly really couldn't say that gold has bottomed out. Just because it's moved slightly higher this morning doesn't really strengthen the view that it started to move upwards. It still could push back into these areas around 1900. Anyway, to turn to crude oil, a market that is going and going and refuses to stop, because if you looked at Tuesday, we briefly dipped below 80 and then suddenly the buyers came back in again. We're at a new high for the year here in crude oil. I can hear excitement from here, really, especially drivers looking at petrol prices. But back, crucially, now finding ourselves pushing on above 83.40, which was resistance at the beginning of December. It was where the April bounce hit a wall and then fell back again. So what could have been an interesting area of resistance appears not to have been, or certainly been broken. We had a daily close above it yesterday, so that's broken. Arguably, the buyers remain in control, and the uptrend still intact. For that to change, it needs to go back below 79, and that would even just then suggest consolidation. So the buyers still firmly in charge, with the longer term view then taking us on towards 88, call it $89, and then onto that November high at 92.95. No sign yet of any real negative price action at all. As you can see, after the briefest of dips last Wednesday, the buyers came back in again. They didn't even allow for a lower close on Tuesday. Really firmly in control here. Today sees US CPI release, expecting a slight revival in price growth year on year, although the month-on-month figure remains in line. Actually, if you look at core CPI, which is the figure that excludes food and energy, it is expected to slow slightly year on year. So that picture of US inflation growth easing could well be maintained, I think. So do watch that. That's released at 1:30 UK time, which is just, of course, when Beat the Street will be live. So we'll be covering that live on IG as well. But that's it for me. Thank you for joining us, and we will see you again tomorrow at 10:30.